We are meeting today for the presentation of the second report published by the ResearchCentre on multi-capital accounting models and a first deep dive in the subject. Just before starting, a few housekeeping rules. As previously, just so that I can let you know if you're joining us, we will have our camera on whenever we are speaking, and participants are asked to kindly keep their camera and mic off during the presentations. And also, please be aware that all sessions are recorded. The presentation will consist in 3 parts. First, a report presentation, then a discussion with the panel, and a Q&A with the participants to finish with. Our panel today, and I would like to invite you to switch your cameras on if you can, is Shari Littan from the IMA, the Institute of Management Accountants. She holds the role of Director of Corporate Reporting and Research Policy. Joining us as well today is Mark Gough from I hope the pronunciation of your surname is correct, Mark, from the Capitals Coalition. He's the Managing Director, and my name is Souâd Taïbi. I'm Accounting for Sustainability professor and researcher at Audencia and a member of the Integrated Multi-Capital Performance Research Center. So let's start with the report presentation. We will be going through seeing 4 elements of this report. First, some context of the history, some technical steps which are explained in the report, and a preview of the results and the use that have been identified. And we will finish with some thoughts on how this type of accounting can actually be used for sustainability. Just as far as the perimeter of the study is concerned, the study is based on multi-capital experimentations which have been made public, and as such do not contain all the experimentations which might have been put in place by other organizations but not communicated. We are having a focus on sustainability assessment models in priority, the integrated models being treated in our methodology report, as Emmanuel mentioned it earlier if you were part of the previous session. So what's the history of the multi-model capitals we're talking about? The history moves back to the 90s, even though the first work and question of sustainability emerged in the 70s. The first experiments of accounting that we could trace for this report started in the 90s up to the beginning of the 20s, and they were exploratory full cost accounting experiments which had for aim to make visible the negative externalities that's on the environment that organizations can have through their activities. Second movement is still concerned with environmental impacts and externalities integration, and is characterized by the emergence of models which refer to financial accounting structures such as the EP&L. At the same time, in the year tens, we can trace the emergence of sustainability assessment models, which were created to not only report on negative externalities, but also on enabling the possibility to account for positive social externalities. And for the last few years, we have observed a rise in the multi-capital dashboards efforts with a look for value and how to put in light the whole values or the different types of values that organizations are creating through their activities. In the report, so we're focusing on 2 types of models, the full cost accounting models, which integrate the cost of negative externalities, which leads to reduced profit but has no true impact on the financial health of the company. One key example, which is still in use today, is the EPNL, or Environmental Profit and Loss Model by Kering, which is communicated for the whole group since 2015. The other type of models are the sustainability assessment models, which, as said before, are looking for created value as well as destroyed value and tend to communicate on the net value created, still without changing in any way the information on the financial health of the company. These models first appeared in the academic world and have been since then developed by consultants companies such as Pricewaterhouse, KPMG, EY, and Trucost. And last and not least, you will also find some data on valuation methods used by Root 2 with two British experiments. I will let you discover more about this in the reports when it will be published in July. There is a basic vision of the organization underlying all of these models. And this basic vision is that the organization is like an organism, a being which has inputs, or a machine, which transforms inputs into outputs. And these outputs have effects on nature and society, these effects being the outcomes of the outputs and the impacts linked to these outcomes. But we will come back to this differentiation in the words shortly. What does it mean? Clearly, is that the organization, through its outputs and its resources consumption, is having outcomes, is created outcomes on the environment. These environmental outcomes are possible pollution, or, for the example of CO2, the contribution to the global warming. Once these outcomes, both environmental and social, are identified, the next step, which has been put in place by all the models we've treated in this report, is to monetize them in a way that is consistent with an evaluation of the impacts on society and the value that society is giving to these impacts. This value can be defined as values obtained from individuals, as values lost or created for businesses, as well as on the impact of deterioration or increase in value of built capital and capital assets. To understand how these outputs are translated into outcomes, a certain number of methods can be used. In order to develop the whole method, there are 4 steps which are common to all experiments and which have been theorized in the 90s by Gray and Bebbington. First is the definition of the entity, so the perimeters, which is actually examined and studied. The second step focuses more on defining the limits, the scope of the analysis, but also the nature of the impacts that are going to be studied and reported on. The third step involves the quantification of the physical flows resulting to the impact measures. And the fourth and final step consists in monetizing the impacts created. In order to measure the outcomes and to define the physical flows, 2 big methodologies can be found in the experiments. The first one is life cycle analysis, with the logic of taking into account all the steps in the defined perimeter and identify all the inputs and outputs which are linked to each of these steps. On its largest scale, a life cycle analysis will identify the flows from linked to all steps of the life of the product or the organization, from raw material extraction to end of life. And each of the steps, such as design and manufacture, distribution, usage, and end of life will need to be analyzed or modelized in order to be able to account for things such as greenhouse gas emissions and contribution to global warming, water consumption, water eutrophication, effect on the quality of air, and sometimes and ecotoxicity, both for living animals or for plants or even humans. The question of toxicity is something that we encounter quite a lot when we are looking at the effect of environmental pollution onto human well-being, and this is often treated through the logic of impact pathways, which tries and to modelize how an emission and output in the air can ultimately affect human health through the way it's going to travel in the environment and finally be inhaled or ingested by the individuals. And this impact on human health, as measured through these methods, is then monetized using several types of of methods. The preferred method linked to the logic of externalities internalization, which is at the basis of these models, is to look for a market value. So more often than not, CO2 emissions for which a market exists will be valued depending on the market value of CO2 emissions. When no market value exists, then another range of methods can be used. When we talk about human health, you can have the value of statistical life or the cost of a day of health lost, that's the DALI, and WHO, the World Health Organization, can, for example, provide data on the value of day of health lost, depending on the age and on the country where the people are. Other methods are very commonly used whenever a willingness to pay from society is being examined. And you can have either stated preferences, where we ask people for their opinion or give them a budget and ask them to prioritize effects, or revealed preferences, where we try and approximate the element we're trying to value to an existing market and define how this element of nature, for example, like a natural park, is actually valued by society. And these methods are what enables the monetization process most of the time and enables an evaluation of value for society of the externalities, both positive and negative, that organizations can have on society and the environment. What else will you find in the report when you will be able to read it in detail? It consists in the look under the hood of the experiments. The point is to be able to communicate and make more obvious or more visible for all users the scopes and how detailed the scopes that are being used are communicated and taken into account. So you will have experiments which will focus really on the limits of the organizations, scope 1 and 2, whereas some models will try and encompass for a larger part of the life cycle of their activities. And still, in some cases, only small parts of the value chain will be taken into account, or only the end life, or not the usage steps. So depending on data availability, on scope identified for the experiment, each result will vary as far as the scope studied is concerned. Second type of results you'll be able to access in this report is the type of impacts which are correlated to environment or social or human capitals, and how these impacts are defined through their indicators and measured through their indicators. We have also aimed at a full I've given you all the data available as far as the sources that were being used to measure and monetize the results that were used, and the monetization sources. Something that might be particularly of interest for you is a table which will be made available, summarizing for each impact the monetization value, the calculation methods, and the sources that were used, which means that you will be able to have an overview of what has been used so far to report on natural capital, with which type of impact, which type of measurement, and how this measurement have been achieved. Last but not least, for each experiment, we will communicate how the organizations have communicated on its use and how they have invested in the models, meaning by investment, uh, we mean how they have been using it, either as a one-off experiments, which was the case for nearly 50% of the reports we have been able to study. All the reports being reports which have been made public were used for CSR communication, but the perimeter of our study means that obviously they were being used for communication, and only a few actually communicated using this method as a management tool or a strategic tool. Some limitation coming from the methods have emerged. The question being that whenever we're talking about natural capital, we might be thinking that any company talking about natural capital is referring to the same definition of it. What comes out is that there can be different impacts taken into account from one company to another whenever they're talking about natural, social, or human capital. Even when the impact is the same, let's say greenhouse gas emission, the unit for expression is the same, let's say a value per ton of CO2 emitted, can we still suppose that there is comparability in this data? Well, the answer is that most of the time we cannot reach this type of conclusion for two reasons: because of the scopes and because of the methods of valuation. As I told you earlier, the scopes taken into account vary, and the CO2 valuation, the value given to a ton of CO2 equivalent gas emitted, is quite variable depending on the method that has been used. In the report, we have examined when the value of ton CO2 equivalent was communicated. It could range from values from between $25 or $57 per ton, which means that whenever you are looking at a result in monetary term or even in CO2 equivalent, all these data need to be contextualized, and you need to have comments in order to better understand which emissions we are talking about for which scope and what is behind the value of monetization that has been used. This variability can also be observed in human capital with a large range of definitions which can be used. For some human capitals, contribution to human capitals is expressed through the wages. Others, for training, use a valuation method based on the expected increase in wages for the employees which were trained. Others add the value of health cover, of well-being programs, etc., etc., etc. Some include injury costs, some don't, some employee investment or pro bono activity. So in a nutshell, the message is to look behind the figure and make sure that you study what elements are being communicated on whenever you read something about human capital or natural capital or social capital. As a conclusion for this presentation, we would say that to move from CSR accounting, as we've observed in these reports, to accounting for sustainability, and in a line which has been created many years for many years by researchers like Rob Gray, Jan Bebbington, or Carlos Larinaga. Accounting for sustainability means that that the tool needs to be system informed in order to enable a clear understanding of what's happening, and transformative in order to help organization and society move towards a more sustainable practices. What does system informed involve? Well, one of the first proposal from our research center is to put back the economy where it belongs as a physical reality, which means that economy is embedded in society and society is itself embedded in the environment, so that the order of priorities whenever we're thinking about sustainability of the system has to be taken into account and to be visible. The other issue for system-informed accounting models is the visibility of the physical data and the contextualization, a proper definition of how this data has been achieved, what might be the blind spots in the method, and how it could be improved. Transformative. With the notion of transformative, I propose today two main points. The fact that this measurement or this report should be associated to a goal, being a goal of respecting planetary boundaries or the SDGs, but a goal that look at sustainability as a desired state for society in general and as a contribution of the organization. And it also needs to be actionable by management in order to help the organization move towards more sustainable practices on a daily basis. So that's in a nutshell and very quickly some of the elements you will be able to find in the report. I would like now to ask Shari and Mark to switch their cameras and microphone on so that we can move on to the panel discussion.
Am I on? Can
Yes,
you
you are.
hear me? Okay, good.
I believe you are. Mark, I can't see you yet. Can you maybe
here.
join us?
Can
you are
me?
here?
Yeah.
Okay.
I think Ralph is also on, so I'm not Ralph today. I always like to be, but I'm not.
Okay, so
I think
Ralph.
I see both Shari and Mark and you, and
yes.
I'll just ask the other ones to just shut their camera off so that we can enjoy the conversation, and that should be all okay.
Thank you. So to start our conversation, I would like to ask you both how you think that multi-capital models contribute to reaching global sustainability goals. Whoever would like to start? What sort of contribution do multi-capital models have to reaching global sustainability goals?
I will start, and I will say hello to everyone. I still am finding the term multi-capital and the goals of multi-capital challenging, extremely challenging. I think that when I hear the term, I am trying to understand whether the term is aiming to speak to the resources themselves, or are we trying to speak to the stakeholders who are contributing resources to some ongoing enterprise? And to the extent that that terminology is confusing and is not, it makes it challenging to align it and speak to it in a cohesive way with existing accounting and reporting. And I think that becomes an implementation challenge and for widespread adoption.
Mark, you might want to react to Shari's statement.
I think I know what Shari's saying about the challenge around the framing of this, but I think that things have moved massively over the last 10 to 20 years in this space. When we first brought together, the Capitals Coalition is the uniting of the natural capital community and the social and human capital community, who both had separate different approaches, and they've all come together through the work we're doing now. We're about 400 organizations around the world at the core, and about 20,000 individuals who are now applying this multi-capitals approach in different ways. I think the thing is that Capitals has helped us to put some of the sustainability initiatives and ideas, circular economy and things like that, start putting those into a framing where we can embed this into internal decision making. The challenge comes when we start trying to move that into external reporting, and I think there are challenges there, but your study, and I know we talked about this yesterday, but your study looked very much at what was publicly available. Most of the people we talk to are talking about things that they do internally, the internal decision making. So the many applications that we see, they're using this concept of capital, which really is about the value that's being created, not just the numbers, to put those into a context to help to inform decisions. So for example, the electrification of cars. All 26 of the major car manufacturers have used a capitals thinking to actually help them to make that transition in their business models. And we've worked with them in different shapes and forms to move from one to the other. So that internal decision-making process, I think we found a massive help in talking to CFOs, building it into internal models, internal processes to use this capitals framing. When we start taking this into an external disclosure, I think that is another question.
I'm going to say that I am not observing the same widespread adoption of what you're saying. I have seen it experimentally at companies that have incredibly large budgets that are interested in this type of accounting. But on a day-to-day implementation aspect, I am not necessarily seeing, and I do, we are the Institute, I'm not speaking on behalf of the Institute of Management Accountants, but I do believe that you're right, that it does need to be actionable. I'm just not sure that you need to use those multi-capital frameworks, whatever that means, and how that translates to conventional accounting, because I'm still not hearing an answer to my first question, which is, are we speaking about the resources, or are we speaking about the stakeholders who are contributing those resources? Because those are not necessarily the same.
Completely, they're not. And I think that when we talk about, for me, the main thing about this is moving away from quantified amounts, which when we start bringing in these sustainability elements, saying 1,000 people have been hired means nothing. What we really need to talk about is the value that those people are contributing to society, where that value is. So for me, a capitals model is allowing us to start putting that question into the way that we do it. So rather than the accounts just saying we've got 1,000 employees, isn't that good, which we see happening again and again and again by companies, we're actually asking them the question, so what does that mean for society? Where is the value? Who is actually impacted by this? Who are the stakeholders? What are the resources you're drawing down on for that? So the stock, capital is a stock of resources that creates a flow of benefits to people. It's all about that well-being at the end of it. Using that framing may not work for everyone. I think we do see a lot of companies, most companies that come to us, and we've got thousands of companies around the world that are applying this in different ways. Most of them are doing experimental projects. Most of them are testing this out. It isn't mainstream. I completely agree with you with that. But it is increasing exponentially on where our models of what we were expecting to get to by this point.
Yes.
We're way beyond that, with companies talking about it in the mainstream now.
I just think that we need to be absolutely clear that if we want people to understand that we use terminology in a way that is consistent, if we want to see an integration of mainstream accounting and various forms of sustainable business accounting, if we want to see that, then we have to be careful with the use of terminology and not assume that everyone understands what's being, I mean, in one group, everyone is familiar with the terminology, and to others, it's brand new and radical. So I'm just suggesting that the term multi-capital itself raises for me questions of whether, again, whether we're speaking about the resources themselves versus those who are contributing the resources. Another thing that I'm hearing from Mark is a confusion around impact accounting versus what we call more of an entity or value-based accounting. There are ways for those two, in my view, to get there, but we need to be absolutely clear when we speak to people with which one we're talking about, because there is such enormous confusion, and that confusion is creating and contributing to resistance in some quarters.
I think your point about the where we've been up until now has been very much a voluntary process. So the natural capital protocol that was brought together, the 40 major approaches around the world, from the UN to the PwC and others, they sat in a room for 18 months and they consolidated their work, harmonized it into a protocol which is now recognized by the UN, the EU and others, is written into the Corporate Sustainability Reporting Directive, Article 38 and things like that, as being a way that we could take this forward, okay? I can see you smiling there. But let's just for a moment, that's all been a voluntary approach. That's all been written in the language of could, okay? So you could do this, you could do that. We host many of the conversations, exactly as you're saying, Shari, that are coming together of people of communities, from scientists, talking to finance, talking to business, talking to the government dialogue we run. We host these really difficult conversations. And I agree with you, there is confusing. But it is coming together, and two projects we're running at the moment, the Transparent and the Align project, both funded by the EU, are now taking those natural capital, for example, just starting with those, and we also look at social and human, but it's taking those and now saying, well, what is the minimum requirement of what you need to include in it? What is the standardization of it? So it's moving from a could language to a should and a must. And that is going to go out for consultation quite soon. We've got a big group of people, all of the people from the ISO movement and others contributing to that. I think this will help us, particularly with the SME movement. We're running, in fact, today, workshops later. We've got 600 businesses in the agricultural sector at the moment looking to apply this to help them to look at the food sector, with the Food Sector Summit coming on at the moment. And we're just looking at one small element of that, along with the UN and others. So I agree that there is confusion, but I disagree that actually that this isn't a helpful way of framing things. I think we are finding people that are making very active decisions that are helping them to be able to transform the way that they're looking at business models, look at the way that they need to be able to deliver the SDGs. And this is a way that can help them. It isn't a bright, shiny thing. It isn't a big activity that you may want to put in the front of your report. But most of the people that use this are actually using this for internal decision making to deal with risks and opportunities that are appearing in their supply chains and their value chains and things like that. This isn't something, this is a basic standard accounting process that they're trying to bring in.
So if I may enter the conversation, I think
why are we having so much fun here? Go on, please.
the question is also, when I think where Shari was coming from in the beginning is whether you define the capital as the flow of items or as something which is brought, a capital as resources which are being brought by shareholders, these shareholders being financiers or nature, whenever they are the resources. I think that's what she was trying to refer to at the very start, and how. Yes.
No, I think what I'm trying to say here is that it is not just financial resources. Every business, every enterprise is a collection of resources contributed by various stakeholders. That's all I'm saying. And some of those contributors do infuse cash. They cash, and others bring their talent. And the community brings their resources in as well. The community is a stakeholder. And so it is beneficial, I think, to separate the idea of the resources being contributed to an enterprise and think about those who are contributing separately. They're not the same. So if I work for an organization, I contribute my talent resources, and my talent resources are one thing that the organization is using, but they're not using me. I'm agreeing to contribute them. And I think that separation still has benefit today.
And that's so with capitals, the capital is a stock of something. That's what financial capital, any other, is a stock. So that's the bit that you're drawing down upon, the dependency upon it.
I guess my question is, are you speaking of the resource or the contributor when you say capital, multi-capital?
Well, one of the things that we've been doing since we united the natural, social, and human last year. So the multi-capital, I have challenges with as well myself. And the consultation that we did last year with lots of people looked at different results. If you do a single capital assessment, you get one result. If you do a multi-capital assessment where you get add them together, you get a different result. What I'm talking about, where most people we're starting to talk to at the moment, is looking at an integrated one, where you have to understand both the stock of resources that are coming and where that's coming from. So you have to look at the interplay between those, and you actually get different results at the end of that as well. So if you just look at one element of this in itself, so most of the people that started with us doing natural capital assessments, by the time they got to 5 or 6, they realized they needed to think about where that stock was being delivered from, the people that were involved, the impact upon health, and various other things around it as well. They couldn't just look at one capital.
I'm still confused. I don't know that I still have a clear answer.
I think, Shari, depending on the method and depending on how the calculation is being made, models can refer to one or the other. And the question is how the comments and the data which is communicated with the models can help the users understand the position which is behind the model. So I guess the answer is there is not one answer. There are different answers depending on how the things are being addressed. Still, there is a common ground on all of them, is the fact that the value or the dimension of reporting is a monetary value in all the cases we have studied. And one of the questions is how much monetization can help to shift practice towards sustainability and better understand how organizations can change their practices towards more sustainability through these models. Who would like to take this stage? Maybe Mark?
Yes, by all means. So monetization is a very difficult question. It's often confused with value. So people often, when we talk about value, just think of the monetary value. They don't think of the value created by people that can be brought into an organization or into a government or into a policy decision as well. So being able to understand really what value is, the relative importance and worth of something, is extremely important here. About half of the community that we represent, about the 20,000 odd, are using monetarization of some kind. Definitely within some of the bigger corporates, they want to look at that to be able to compare. And for a CapEx decision or for something where you're looking for that, it's useful to have a monetization. There's a lot of conversations, though, where it's useful not to have that. And actually, you don't need to have a monetization. And what we're really talking about is the relative importance and worth of something. We're trying to make information useful and relevant for people. The conceptual framework of the IFRS says it should be useful and relevant. And actually, most of the information we use is not, I find. It's actually quantified amounts. It's not actually being put into context. So for me, what we're trying to do, and most of the people we're working with, are looking at trying to provide that context. And if we can provide that context, then we're in a position to actually make that information useful and relevant for the decision makers to make better decisions. So it doesn't have to be monetized from my point of view, but there is a lot of people that are working towards that.
Okay, Shari, I think you had some comments about how these tools can be used by management to inform their decisions. Do you believe that monetization is important for people in the organization to make decisions?
I think that if you are trying to reach certain, the purpose of accounting at all times is to inform somebody's decision. And It depends on who you are trying to reach and what information you're trying to provide. So an accounting system or model really needs to think about the user, and does the user find monetized information useful, or do they find it not useful?
Okay, fair enough. Okay.
I mean, the answer is, if you're trying to engage people who are CFOs and decision makers, it's probably, if you speak to them in monetized terms, you will probably get greater engagement. That may not be true for policymakers, which is why any accounting model or process needs to think about who is the user and what information they actually need, so that we don't waste. One of the things we don't want to do is waste our accounting resources, right? We're trying to be sustainable with our accounting teams and our talent resources. And so just, constantly measuring and reporting without identifying the user and who needs that information is really critically important to avoid that waste.
And that is the first step of the protocol as well, both the human and social and the natural capital protocol, is being really clear about why you need this information. We don't want to be collecting information just for the sake of it. And in fact, most of the work we've seen at a national level about statistical accounting in this space has been producing accounts without actually having an understanding of the policy that they might drive. There's certain places, Australia, I was on a call with them this morning, and other places, where they are now designing policies and then collecting the right data for it. But when we first started this, businesses, what we were talking to, wouldn't go into it. They're not going to put resources into collecting information they're not going to use most of the time.
Exactly.
So what they were doing is they were saying, well, what is the problem I've got? I haven't got sugar in my supply chain. I've got 2 weeks supply of it. How do I address that problem? How is this information going to help me? If it doesn't help me, I won't use it. But if it does help me, I will use it. And that defines whether you use monetization, which valuation approach you might use, how much right context you might need. That's when it really starts becoming useful.
Yeah, and I think that when we talk about an external reporting context, we frequently hear the term materiality, right? Materiality is what seems to be important for the user, but there's a corresponding concept which I call actionability, which Souâd introduced, which is, again, we don't want to waste resources simply measuring and reporting and leaving no resources left to be actionable by management, which is a flaw that we've seen in mainstream accounting, where we're reporting on a whole bunch of stuff. Why? Because it's required that a CFO or members of management say, I don't use this information for anything. And that would be a wasteful and unsustainable route for this type of accounting to follow suit. So materiality is one aspect, but management as user to take action needs to have those resources available to do that.
And the challenge with that is that I completely agree with you there. And all of our work actually has been based around that internal decision-making processes and making information useful, not about disclosure. There's plenty in our network that do look at the standards for disclosure. The Impact Management Project and others are doing some good work now about trying to build that on that. But all of our work's been based on making information useful up until now. And I think that's got to be the basis for this. We then do need to link through to what then is disclosed, but that is a bridge to it based around what is useful all the time. We've got to come back down to why this information is being collected, and we've got to collect it to actually help to make actionable decisions.
Excellent. My last question was about the challenge and opportunities you foresee for accounting models to account for sustainability. But I think your last comments were actually quite a good answer to this question. And there are quite a lot of activity on the chat. So I would like to open the floor to the questions. Delphine, if you would like to help us bring the questions forward.
It was lively on the chat, so I'm going to try and go back to one of the first. And sorry if I miss some of your questions, because the conversation has been ongoing. But A question from Australia about accounting has always been concerned with stocks and flows and their articulation. In a multi-capital context, we have capital stocks and changes in these stocks over time. How do the speakers relate to the multi-capital accounting model to the articulations of these stocks and flows? Maybe that's a question also for Mark.
So I think one of the key things for me, and I spent many years working in business before this, getting board papers telling me certain things that I should do just because of the financial reason. And now we're trying to build in other reasons, other justifications for doing things to actually provide the uses, the provision of nature and people into those decisions. But the stocks and flows has always been a problem because a lot of the time decisions are made by just looking at one of them. One of the things I think the Capitals is helping to do is to help to look at both the stock and the flow. That actually it's important. You could draw down continually on a flow without recognizing that the stock is depleting, or you can just measure the stocks without understanding the benefits that are going to be provided by it. So for us, it's really important to always look at stock and flow in the way that you're measuring it. How do you account for that? That is challenging. I agree. But I think it's important to always look at stocks and flow. And that's, for me, something that's come through some of these conversations to the fore more recently.
A question maybe to Shari this time. It has come in the conversation many times about monetization. I'll read out some of the comments. I'm trying to see it is part of the challenge in the approach, the difficulty in trying to quantitatively compare apples and oranges or bees with euros. And to follow up this, the same participants was asking whether we need some kind of multi-capital fungible measure to value. This is also coming to the conversation of stakeholder use and not content, but use of the multi-capital accounts that could be CFOs. I know, Shari, you've written some reports on CFOs and value creation. Can you speak to that and the need or not to have that monetization to speak to finance people more broadly?
Yeah, so first on the question of monetization, translating, if you want to engage mainstream CFOs, which are still, and their team, which is still instrumental in decision making, then of course monetization helps because that is the language that they look at. And if you say to them, our CO2 emissions are down, or something, they'll say, okay, what does that mean for me? Can't translate what that means for me, how it affects me. So I think that the question for me specifically is not a monetization versus monetization. Again, it goes back to that question of who is the user, right? Accounting needs to inform someone for making a decision. We don't want to just account for something. What gets measured gets managed unless all I do is measure and I have no resources left to manage. So that's why we want to, if we are using accounting to engage and for decision making, and the CFO is your audience, then yes, monetization is extremely important because that's the language. A policymaker might have a different viewpoint, and that's a different user for a different accounting or corporate report. So that's why, again, as Mark was saying, the user is absolutely instrumental. Going to the second question of multi-capital, I'm going to say I still think that and that goes to that old-fashioned concept of the balance sheet, which I was talking about, still works. It's not perfect because of the things that we choose to account for or not account for. And we can talk about intangible value, and we could talk about the contributions of various stakeholders who are contributing that value. And for me, I think that model still works. I think that if we look at an enterprise not as a black box, but a collection of resources contributed by stakeholders, and each of those stakeholders has an interest, a claim on that ongoing enterprise, saying, here's what I expect of you when you use my resources. And that could be mainstream bondholders, lenders, and equity investors, but it is also the employees. It is also the community, Mother Nature, the commons, the taxpayers. They are contributors to the enterprise. And I think that model works for me.
I think also, if I must just quickly jump in there, the value to who is one of the questions that's really important here as well. Not just where the value is coming from, but value to who. On the Food Systems Summit, the UN summit at the moment, there's just been an announcement this morning that a lot of scientists and local indigenous people have stepped away from this and said they're not going to be involved because they feel this is all being done without them being involved in the process. And that's because we're not thinking about where is the value going to end up. You know, if a business is actually creating value, it's not just creating economic value for itself, it's actually creating things within the community, or it should be. If it's not, then there's a question by the community about what is going on, in the same way that, and this is the whole thing about purpose with business as well, which is a very common topic now being asked. So I do think that capitals can help us to address some of that, because it does start raising that question about value to who, who's getting this value at the end of this process.
Maybe, Shari, I'll go back to one of your comments at the very beginning when Souâd ended the presentation. You talked about the new SEC proposition about human capital and the difficulty to measure that human capital. Maybe that's actually a hot topic for that I've been also contacted on to discuss. So maybe Mark, you will have something to say. Maybe Shari, can you start on this?
Yeah, so as our audience may or may not know, in the U.S., we're starting to catch up, and so our Securities Exchange Commission has mandated the reporting of human capital resources in the annual disclosures. And that leads to a very important accounting question is, well, what do we report and how do we report it? Because it's one thing to say, please report this. And one thing that we see as a challenge is that companies are often looked at a black box of resources that can just keep spent, that unlimited resources, but information costs money and you need a process to do that. So we're watching this new mandate come in and companies saying, okay, are my part-time employees part of my employee definition? What about people who I furloughed during the pandemic? Should I include them? What do you mean by diversity? Who gets included? And so some of the questions that get raised that seem so simple and basic, well, just come up with this number, start to become a new process within the company, and then they have to figure out, okay, which data do I gather, and am I responding, or which, and then it goes to what Mark, well, which is more meaningful, and it's that becomes a true challenge for them in actually implementing, and that's only one type of measurement. So we can see how it hits in practice.
And it's great to see what the Securities Exchange Commission has been doing. We've been inundated with new members joining our coalition about that particular question, as you can imagine. One of the projects which we've started up with Shift, which is the human rights project, which is part of the coalition out in Washington at the moment, is looking at living wage. And to me, living wage is such an obvious thing that we should all be doing. We should all be paying people a living wage to work. But why has it not been picked up? It hasn't been picked up, I think, basically because of the accounting rules around it and the way that we look at it. The way that we look at, when you go to a CFO at the moment, say, we should do living wage, obviously, emotionally, the board will sit around and say, of course we should. Then the CFO says, but it's going to cost me, and it goes on my balance sheet as a cost. I can't keep on increasing my costs every year. I'm not going to do it. I can't keep on increasing those costs. And cost is the main reason why all these wonderful projects and activities and initiatives out there to try and implement a living wage is not working. This project we're doing with Shift at the moment is actually looking at how we might be able to adjust that. oil and gas exploration has always been put down as an investment. Okay, they put it down as an investment onto the way that they account for it, so they can amortize it over a period of 5 or 6 years. They can look at where they might get to, and therefore they can look at the investment. We don't look at people as an investment, and yet every annual report says that people are their greatest asset and that they are an investment, and yet they never put it into their accounts as an investment. That is a really interesting question.
Well, I just want to respond because one of the things that I am researching now is the idea of management of intangibles. And so much of the construct that you're saying that costs related to employees is an expense, not an investment. And that mindset is being driven by mainstream accounting, which says, well, that is an expense and not an investment. And that's a construct. It really could be, if you're going to look at it from management perspective, regardless of how it's reported. I want to know if I'm getting a return on an investment like living wage or like training, research and development. All of these things are expenses in mainstream accounting, but that doesn't mean they're truly not building value.
Exactly. Yeah.
Thank you very much, Shari. And I've put the links to your work, and I think there were questions about Mark, your event, so I've put the link to that too. There is I think remarks that are still being put there, but it's related to the intangibles and then the discussion here. One question,
yes,
maybe a question from Paul Haney, a difficult question, I guess he says. So maybe you'll see if you want to touch on this, Mark. It's what's the cost if one isn't sympathetic to the living wage?
So there are Mazars, there's several organizations. Mazars is a consultancy at the moment, doing quite a lot of work researching into this. There's various others that are looking at actually, if you don't pay it, what is the implications for your business? And there are models and people now looking at saying, well, actually, if they had been paying a living wage, what would it have meant? So there's a lot of scenario planning and things, but I think we are getting to the point now where there is data. I think the challenge is it comes back to almost the first bit of this. What do we make public? Most of the people we talk to are talking about internal problems and challenges that they're working with. You don't go and tell your investors and your shareholders the challenges you've got. What you do is you say, I had a hole in my backyard. I've now fixed that and I know what I need to do about it. You don't go to your investors and start setting out all of your problems. Otherwise, that tends to affect your share price. So a lot of this is still being done behind closed doors. I think we do need to start getting some of those good examples to start coming out and to start being able to talk about them in a very open way. And I think that will address some of Shari's challenges at the beginning, that actually there is still confusion about this, because I think that there is consistency starting to build, but until we can start talking about this in a consistent way, and I'm not talking about actually here about being able to compare. Comparison is something very different to consistency. We've got to get to consistency with this. We're not looking for comparable results. We're looking for consistency in the approach. And that's really an important mistake that's made often. So I think that we need to start, and I feel we're getting to that point now. There's more and more. I'm doing 5 events today talking about this. My diary is completely and utterly enjammed with different things going on. There's a lot of people trying to grapple with this. We don't have the answers, but together in these sorts of conversations, we are getting closer every time, I think.
I think that will be the end, consistency and not comparability. But Souâd, if you'd like to maybe close the session.
Yes, definitely. Thank you very much for all your contribution and all the energy which was put in our conversation. And so I will just share my screen again to let you know what's coming up. Everybody, we're going to have a lunch break. Sorry, I'm having trouble finding it.
It's lunch break after 3 conferences. It's long break. Thank you so much, Shari and Mark, for being with us today. And we will reconvene at 12:45.
Thank you, everyone.
Thank you.